So this week, we've got two updates. Firstly, what's happened in markets over the last week, and secondly, an economic update. Then we'll wrap up with what this means for portfolios. So firstly, what's happened in markets over the last week? After the 4 previous weeks where markets have been pretty strong in sterling terms, the last week has been much more flat. We believe that looking back over the period since Brexit, markets have been supported by central bank action. Moving on now to talk about economic activity. With regard to central bank action over the last week and looking into next week, this week we've had the Federal Reserve come out and say they weren't going to raise rates, but there was a high probability that they would raise rates after the September meeting. The market doubts this to a certain extent, and after the statement, we saw the price of gold rise and US bond yields fall. In the meanwhile, sterling has been slightly weaker this week because there is the expectation at next week's Bank of England meeting that interest rates will be cut perhaps by 25 basis points. Moving on to other economic activity, this week we've had flash purchasing managers' indices in the UK. This has suggested a very weak UK economy in the third quarter, which is unsurprising given the Brexit vote. However, in the US and in Europe, we're still seeing positive indicators on economic growth. So what does this mean for clients' portfolios? Our clients' portfolios have done well since the Brexit vote because of the diversification within them, particularly in non-sterling assets. We're looking to lock in some of those gains now and are looking at opportunities perhaps to hedge some of the currency exposure. In addition to that, we're looking at other opportunities for non-equity exposure which could benefit in the current market environment.